Leading Wall Street forecasters see a number of emerging themes driving their 2025 stock market predictions. For the most part, experts are expecting another year of growth for the S&P 500, with the average target price suggesting a rise of about 8%. While each strategist has his or her own reasons for optimism, there are common trends between the forecasts that are worth paying attention to. Here are 4 major themes that experts believe will shape the stock market atmosphere in the coming year. 1. Trump versus the world president-elect. Donald Trump has threatened tariffs against both America's enemies and allies since his election victory in November. In late November, Trump proposed imposing 25% tariffs on goods imported from Canada and Mexico unless they stopped the flow of migrants and tightened the fight against drug trafficking across their borders. More recently, in an interview, Trump called tariffs the most beautiful word and said he never had the opportunity to fully implement tariff policies in his first term because of the pandemic. While some see threats of tariffs as mostly a negotiating tool, others believe Trump is very serious in his proposal to tax imports. If so, it could escalate the trade war, reignite inflation, and ultimately lead to stock market losses. There is expert opinion that supply-side imbalances, including tariffs and mass deportations, are risks to stock gains and could have a negative impact on inflation. Strategists have gone even further, stating in their forecasts that a full-blown trade war will break out next year, causing an economic recession. Hopes for a soft landing failed in 2025 when a trade war and bond market sell-off pushed the global economy into recession, one analyst said in his forecast for next year, writing as if he were looking back in time from January 2026. But if Trump chooses a softer trade strategy and focuses on tax cuts and deregulation, the new administration could be a boon for stocks in 2025. 2. Trump versus the Fed. Trump reiterated that he has no intention of replacing Fed Chairman Jerome Powell before his term ends in 2026. This statement came at a time when the stock market is near record highs, and the Fed, meanwhile, plans to keep cutting interest rates. Will Trump maintain the same stance if any of this changes? That's what Wall Street strategists are pondering. If Trump's policies such as tariffs and mass deportations end up being pro-inflationary, it's likely that the Fed will change its interest rate policy and return to a tight course. The market is forecasting just 2 25 basis point rate cuts next year, far less than expected after Trump's election victory in November. While Trump does not have the power to replace Powell until his term ends, he can use him as a scapegoat, as he did in 2018 by criticizing the central bank and urging officials to cut rates. Ultimately, the stock market wants to see lower interest rates and still expects to see that in 2025. Fundstrat said the Fed's support for the stock market next year will continue. UBS, DataTrek Research, and Morgan Stanley, NYSE MS, also noted that lower interest rates are the reason they expect the stock market to rise in 2025. Any shock in the trajectory of rates could disrupt forecasts and put downward pressure on stocks. 3. Artificial intelligence. Show me the money. The excitement around AI has not slowed down in 2024, and stocks related to the field have once again posted impressive gains. Nvidia's stock is up 170% YTD, after climbing 239% in 2023, while other AI-related companies such as Palantir, Vertiv, and Broadcom are up 329%, 159%, and 93% respectively. But for this trend to continue, investors need to see significant revenue and earnings growth from companies that are actively investing in AI infrastructure. If revenues from AI investments don't materialize, spending on AI chips made by companies like Nvidia and Broadcom could suddenly decline. Wall Street has a big question. They're now spending over $200 billion and their capital expenditures are up over 50%. Where is the return on invested capital? A tech strategist told Business Insider earlier this year. There's also the hope that the productivity boom driven by AI adoption will drive growth throughout the economy. If that doesn't happen in 2025, it could lead to a volatility shock for the tech sector, which has led the stock market for the past 2 years. 4. The consumer, the economy, and earnings. Perhaps most surprising to markets over the past 2 years has been the strength of the economy, which has managed to avoid recession. Economists and strategists were certain that an economic downturn was inevitable in both 2023 and 2024. However, instead the economy boomed and GDP grew at a rate of nearly 3%, higher than before the COVID-19 pandemic. For the stock market to rise again next year, the continued resilience of consumers, the economy and corporate profits is important. Our target level for the S&P 500 for December 2025 is 6,600 and will be supported by sustained economic growth, UBS said in its forecast. That view was supported by nearly all strategists in their 2025 forecasts. If stocks want to continue their bullish trend, the economy must not falter, and as long as the consumer remains resilient, there should be a relatively smooth path for risk assets. The opposing view comes from one of the few bears left on Wall Street, BCA Research, who believe Trump's policies could undermine consumers' financial health by triggering a trade war and raising inflation. The firm has the lowest price target on Wall Street, predicting the benchmark index could fall more than 25% to 4,450. And for your attention, here are the current analytics on China. China's financial markets are experiencing record capital outflows. China faced its largest ever capital outflow from its financial markets in November, as the prospect of higher US tariffs created more risks for the world's second-largest economy, Bloomberg writes. Domestic banks transferred $45.7 billion abroad on behalf of their clients to invest in securities, according to data released by the State Administration of Foreign Exchange on Monday. The amount includes foreign investment in China, as well as purchases of overseas securities by locals. The rising outflows signal worsening sentiment toward the Asian country, as US President-elect Donald Trump's pledge to impose 60% tariffs on Chinese goods threatens to destroy trade between the two countries. Weakness in the yuan and local stocks, as well as a significant interest rate differential between China and the US, increase the risk of a vicious cycle of capital outflows. Threats of tariffs from the US and the rate differential are expected to add pressure to outflows from China, said Ken Chen, Chief Asia Currency Strategist at Mizuho Bank. The advantage of dollar yields is expected to weigh on Asian currencies broadly, he added. Chinese stocks have lost their upward momentum since October, as stimulus measures announced by the authorities failed to meet market expectations. China's benchmark sovereign bond yields are now less than half of what US Treasuries offer. The yuan's domestic exchange rate is also near a one-year low, while the dollar index is trading near two-year highs. Given these challenges, China may continue to seek to revive growth momentum and change investor sentiment so that capital flows back into local assets with low valuations, Chen said. At a key policy meeting last week, China's top leaders signaled an increase in government borrowing and spending in 2025, as well as a reorientation of policy toward consumption in an effort to boost the economy. The Politburo decision-makers, led by President Xi Jinping, have pledged to stick to moderately accommodative monetary policy in 2025, which could mean further interest rate cuts. Foreign institutions reduced their holdings of Chinese government bonds to 2.08 trillion yuan, $285.5 billion, as of last month, to the lowest level since September 2023. According to official data from China Bond, mainland Chinese investors bought $125 billion, $16 billion worth of Hong Kong-listed securities in November, the highest in 3 years, according to data compiled by Bloomberg. That's all the news for today. We look forward to seeing you in the next issue.